opportunities, more investment opportunities than simply securities or bank CDs. So that's what it's about. It's not just that you have the opportunity to determine for yourself what you want to invest in, but it's also that you have a much wider variety of asset opportunities. So the whole idea here is to give you more choices and more control, and hopefully that will lead to a more enjoyable retirement for yourselves.
George, you aren't ready, please.
Sorry about that.
This is just an idea of what the retirement market is made up of, and what you'll see here, and this is to illustrate a point that very few people are aware that you can self-direct your investments and put them in what we call alternative assets or alternative investments. And the reason for that, and again,
George, you aren't ready, please.
we've been around for 30 years, and yet still, every time I talk to people about it, they say, oh, I've never heard of that before. Well, the reason for that is, what do you find on every corner in every city? You find stockbrokers, you find banks, you find mutual fund companies, and they're all based on securities on Wall Street. There are not a lot of companies like ours in the country, in fact. There are probably 15 companies that will provide this service. So we're outnumbered considerably. So the fact that we have garnered 3% of the market, if you will, in alternative investments is not surprising. So, and of course, Wall Street and stockbrokers have a lot more money than we do, and there's a lot more of them. I mentioned these other plans just to let you know that these plans are also eligible to be rolled into.
What is 71? Ready, please, 71.
What distinguishes the self-directed account from any other retirement account or investment is the fact that the account holder makes the decisions. They make the investment decisions as well as the investments. We are not, as a company and as an industry, we do not provide investment advice. It's all on you. Now that doesn't mean you don't have attorneys or accountants and financial planners and other people that is part of your team. But we don't get involved in that part. Okay? So it really is self-directed. The benefit, of course, is it does really provide you a lot more control because you're making all the decisions, and it also gives you the opportunity for a lot more diversification. And we're going to go over some typical alternative investments here in a couple of slides. So if you decide at some point, and some of you already have, that you want to open a self-directed account, basically these are the steps. It's real straightforward. It's really no different than opening any other kind of bank account, if you will. The one thing that makes it a little bit different, you need to choose a custodian. And I'm going to talk about the custodian's responsibilities in a little while. But we are really administering your account. We're also doing some other reporting, which I'll discuss a little more later. Once you've decided on a custodian, you need to then open the account by filling out the application paperwork and so on. Once you've done that, now you're ready to find an investment that appeals to you. That could be buying real estate, it could be making loans, it could be doing a lot of other things. Again, I'll go over those things individually in a little while. Once you've found an investment, then you need to fund the account. That account can be funded a number of ways, but you must have a retirement account in order to move that money into this account. Again, I'll talk about the funding in more detail as well. Once you've funded the account, then you can make the investment, which the custodian does on your behalf. And then here comes the fun part, or the challenging part, and that is to monitor the investment. Once you've made the investment, it's not like stock. You can open the newspaper every couple of days and see whether it's gone up or down. This is something that is not going to be reported except through us, which we do on a quarterly basis. But you really want to keep tabs on the company in which you've invested. Now, obviously, if it's real estate, and and you happen to be in the real estate business, which I assume most of you are, then that's probably pretty easy to do. That's something you would do anyway. You also, though, want to keep an eye on your custodian. I'm not suggesting that the custodians are dishonest, but sometimes they'll make clerical administrative mistakes. They'll misinterpret instructions you may have given them. And you just want to make sure that when you get a statement that it does in fact reflect accurately what you expected it to be. Okay. You throw up your hand if you have a question. Okay, about choosing a custodian. Not all custodians are the same. Some have certain investments that they won't hold. Some won't hold real estate. Some won't hold precious metals. Some won't hold IRA LLCs. And again, I'll talk more about these investments in a little while. You also want to find one that specializes in self-directed IRAs or other retirement plans. By the way, you can also self-direct a 401k if it's an individual 401k. So anything I talk about today will apply to both IRAs and 401ks. Here's a big one, and this is what we run into more than anything, is the cost of maintaining a self-directed account. Because we're not brokers, we're not giving you advice, we're not charging you percentage of the transaction or transaction fees like stockbrokers do, or banks where they hold your money and they're making money on your money.
Aaron, your order is ready, please. Aaron.
The way we make money is by charging fees for the services we provide, and these are typical fees that a custodian will charge. You really want to know what their fees are going to be for the investments that you want to make, so that you're not surprised to find that you're getting charged more than you thought you were. So I can't stress that enough. We get a lot of business from people who have been under the impression that fees were going to be one thing, and it turned out to be something completely different, and it was perhaps more expensive. So do your due diligence on the custodian. The other thing that I think is important is customer service availability, and that also includes where are they located. Dan has an account with a company out of Ohio. Well, they're at least 2 hours ahead. And a lot of people have companies on the East Coast that are 3 hours ahead. So typically the customer service hours are going to be 8 to 5 or something along those lines. So you don't want to limit yourself too much. But that's just something to think about. It is. And something that can make that even less important is if they have a website where you can actually get online and look at your account. So that's another consideration. Okay. Now, what does the custodian do? The custodian basically assists you in opening and funding your account. So you'll fill out forms, and if you have questions, we'll assist you in that process. When it comes to funding, we'll talk about that in a little more detail. That means transferring money from another custodian, or rolling over money from a 401k plan, or making a contribution. You can make a $5,000 or $6,000 per year contribution to your IRA. That's another way to fund your self-directed account. We make the investments for you. We make the distributions to you or to other parties, as well as pay expenses out of your IRA account. We provide you with quarterly statements. We will explain IRS regulations when they come up. And we file certain reports for the IRS. 1099s, most of you are probably familiar with those. If we send you money that becomes a taxable event, we'll report that. Even if it's out of a Roth IRA, it won't be taxable, but it's still something we have to report. And we also report any contributions that have been made, as well as the fair market value of your account. So, as you can see, our role is really an administrative role. Also, let me stress that we don't do anything with your account without your written authorization. So you don't sign an agreement and then we sort of do what we want with the money that you have in your account. We won't make an investment without an authorization form for that specific investment, and for each additional investment, we'll also want a signed authorization form. We won't distribute money from your account or pay any expense without your written authorization. So that's consistent with everything we do. We're required to do that. What we don't do, we don't give investment advice, we don't give legal advice, and we don't give tax advice. We don't give marital advice. So that's real clear. We're not licensed to do that, so consequently we stay away from it. We can talk about the decision process that you may have about the investment or legal issues or tax issues, but we won't tell you what is best in your case. Okay, now I'm going to take a few minutes to talk about the different kinds of IRAs that you can have and a little bit about each one, because I'm assuming some of you are self-employed if you're in the real estate business and may have heard of some of these, but basically the traditional IRA is the one that is a pre-tax retirement account. Basically you make a $5,000 or $6,000 a year contribution to it. By the way, the difference between $5,000 and $6,000 is whether you're over 50 or not. So if you're under 50, your limit's $5,000. If you're over 50, it's $6,000. You can deduct that $5,000 off your Form 1040, so you're not paying tax on that money. You're reducing your gross income by that amount. And then the contributions, the earnings are tax deferred. You don't pay tax on your traditional IRA until you take money out of your IRA, take cash or other assets out of your IRA when you withdraw, which you're not required to do until you reach the age of 70 and a half, at which time you then are required to start taking money out of your IRA, your traditional IRA. Uncle Sam looking for some tax dollars. So when you reach the age of 70 and a half, it's time to start paying up. The Roth IRA is not deductible from you don't deduct the contributions from your income, so you're paying the tax on that money. So Uncle Sam's getting their taxes up front, but the benefit is the earnings on those contributions are tax-free. Now, people and accountants and CPAs will argue about, well, the Roth is the way to go because you don't pay tax on the earnings. Well, I would argue that it really doesn't make a whole lot of difference which way you go, because if you're paying tax on it, then you're taking some of the money out of the investment, right? You're paying that up front. And that money would earn the same earnings as this would. So, in my opinion, and I don't give advice, so you don't have to take this seriously, is that I think one of the biggest benefits of a Roth is that your beneficiaries don't have to worry about paying taxes. I don't know if you're aware, but last year, 2010, the IRS lifted the income limitation on Roth conversions. And so everybody is wanting to, anybody that had over $160,000 of joint income was eligible to do a Roth conversion. Everybody wanted to do Roth conversions. They ended up paying a lot of tax. I think it was the IRS's way of saying, well, if we need some tax money, let's give the people with more money the opportunity to do Roth conversions so we generate some tax dollars. So that was a big transaction. We had a lot of those transactions last year. That's something you really want to discuss with your CPA or accountant, as to whether or not it makes sense to do the conversion, because of the fact that you're going to be paying taxes out of pocket. You're not getting the money from the IRA to pay the taxes. So we've had a lot of people who said, oh, I want to do a Roth conversion. And because you don't pay the taxes until the following April, they say, oh my gosh, I have to pay all that tax. And then they decide, oop, that was a mistake. So then we have to go back and do what is called a recharacterization, which is taking the money from the Roth account and putting it back in the traditional account. All of that costs, we charge fees for all that, moving the money back and forth. So it's something you want to think about it a little bit ahead of time.
So you actually can, if you make a mistake, move it back.
Yeah, and what happens is when people go to pay